Good afternoon, everybody. Thank you for jumping on to the monthly webinar series. I'm Matt DiPasquale. I am one of the partners here at the Voluntary Benefit Shop, and I saw the registration report. I know some of you already know me, and some of you have already been on these before. But just a recap of who we are. Again, I'm one of the three partners here at the Voluntary Benefit Shop, and we're located in Havre de Grace, Maryland. And what we do is, we are a specialist niche broker that is going to be a life with long-term care solution for our broker partners, for clients, and that really is all we focus on these days, is making sure we bring this great product to our mutual clients. My contact information here is below. You're going to be able to reach out to me after this if you want to talk about anything that we discussed today. And of course, the topic at hand is talking about the long-term care solutions as an employer-paid benefit. This is gaining a lot of traction because the way that the market's been going, the way potential legislative updates have been happening. So we're going to talk about the potential ways that you could use this policy to really help with employer-paid options, whether it be as an executive carve-out or for the entire population, or a combination of the two things. Now, this is going to be a refresher at the beginning for some of you, but I want to make sure we're all on the same page. As far as what our programs are, okay, they are a life insurance program at heart, but they're a hybrid policy. And what the hybrid policy does is it automatically converts from being a permanent life insurance plan into a long-term care solution when somebody needs it for long-term care. So, group long-term care policies, as you know, a lot of them have gone by way of the dinosaur. They've become extinct. So these hybrid plans have been the market's reaction to being able to provide a long-term care solution on a group basis, which can be funded by the individuals or on the employer paid side. But we can also offer this without medical questions. Okay, so it being part of a hybrid plan really has advantages. One, because the medical underwriting aspect of it, and also because the nimble nature of the plan, because it's an indemnity policy. That means that the benefits can really be used for anything somebody might need it for. So, you'll hear me talk about this throughout these slides, but it's going to pay cash benefits. And then the cash from those plans can be literally used for anything. It can be used for a facility cost if someone's being cared for at a facility, but also the ones that are managing the care situation might need that money to pay the person's mortgage that's not well, keep them in their house longer, protect that home as an asset. And as the needs of that care situation changes, because it's an indemnity policy, the policy adapts right along with it. So these hybrid plans really have become advantageous, but it's not something that everybody's heard of. So it's an unknown commodity to a lot of people. And it's something that, again, is gaining traction in the market. Now, let's talk about some basic statistics. Okay, so who will need long-term care? 70% of Americans, if they make it to the age of 65 in the United States now, will need long-term care, and most of us are making it to age 65. 20% of those that go into a long-term care situation will actually need it for longer than 5 years, which again can take its toll, from a stress perspective, just overall, that's a load for a family to bear, but also from a financial perspective, of course, that can really hit hard and really wipe out somebody's savings very quickly, for people that have saved their whole lives for retirement. So these numbers in red that you're seeing here on the right-hand side, okay, these are national average numbers. Okay, so if somebody lives in an area where the cost of living is above the national average, then these numbers are going to be even higher. So for for a year for in-home healthcare, you're looking at about $77,000 or $78,000 per year for in-home healthcare. If someone's in a nursing home, the average cost is going to be about $111,000 per year. And a private room in a nursing home, then that's almost $130,000 per year. Those are some big numbers. And remember where I said in the beginning that the hybrid nature of this plan will allow for in-home healthcare situations to be paid for exactly the same. So that's really important because you can see the cost savings here for someone being cared for in their own house. Most people rather be cared for in their own house if they can have loved ones chip in part of the time. Obviously, they'd be more comfortable in their own home than in a facility. But also, you can see here that can help stretch the money longer when you're in a care situation. So again, people work their whole lives to build up their retirement, to be able to afford to go into retirement, and they can see a big portion of their savings being wiped out in the blink of an eye for a care scenario. Now, the bottom two numbers here is that the average for the final 5 years of someone being in a care situation, which isn't limited to Alzheimer's and dementia, but it's often that, can be almost $400,000. And then the
Hey,
last stat,
Robert already gave me like he wants to do it around 3:30. So
and then
um
the last stat here is that, and sorry guys, I
he
should have
just
said
sent
this in the
over the
beginning.
date.
If anybody has any questions, please feel free to throw them into the chat. Chelsea's helping me man the chat, and then we'll open it up and unmute everybody at the end here as well. So the final 5 years for somebody's in a care scenario, you're looking at nearly $400,000. That's a lot of money. And then the bottom stat here is that the average cost per care situation, so not per year, but over the duration of that care, is nearly $200,000. Right. So again, all these numbers on this screen, these numbers can be extremely high for most people. So if you ask somebody like, what would your plan be if you don't have an insurance policy or you don't have the cash set aside to deal with this? I hear the same thing all the time. My spouse will outlive me, they'll take care of me. Or more commonly, hopefully my kids take care of me. I took care of them their whole lives. And I have a 4-year-old daughter. You can see her over my shoulder in these pictures. Frankie, I don't want her having to change my sheets, feeding me, changing my diapers because she has no other option financially. So people don't get this policy so much for themselves. They're getting it to give their loved ones, the people that love them the most, and that you love the most, financial options so they have flexibility to navigate that care situation to the best of their ability and by whatever choices and whatever's best for them at that point and not be limited from a financial perspective. This is some benchmarking on the growth of these sales in the industry. What we're seeing is that these products have literally skyrocketed in popularity. So all of the carriers are seeing great growth in this. That's why you're seeing more and more carriers try to jump into the market. Many new players have gotten in there, trying to throw their hat in the ring, because you're seeing employees and employers clamor for it. The legislation aspect of it, which we're going to touch on in a second, certainly hasn't hurt the conversation. It's putting it on the forefront of people's minds. But really, the statistics and the need is what's driving the clamoring for these plans. People have seen loved ones go through this. Everyone's had to go visit somebody in a nursing home or assisted living facility. It doesn't look like the most ideal place to be. So, again, having these types of plans that can help, people navigate that scenario, have financial flexibility and choice and freedom to decide the best route to go, really helps people in these situations, and it's appealing. So, you got to give your clients these solutions because they need it. They want it. And being able to give people access to a policy where not everybody knows where to go. Not everybody's working with a financial planner on the individual market. Not everybody can qualify on the individual market. So being able to give people easy access to a plan where you can help folks from an underwriting perspective really is something that, it's a service that really every company should look into. Most accounts don't have this solution figured out. So there is an opening to provide them a solution that can help them stand out in a tight labor market, help them attract and retain, key employees. All right, so few statistics here that we've already hit on, but a few new ones for you. We're going to talk about the third one down here in a second, where people think Medicare, Medicaid, and the health insurance will help them in a long-term care situation. They don't. Health insurance does not, but Medicare and Medicaid can help folks, and I'll dive into that deeper here in a moment. The fourth one down is only about a third of employers are offering a long-term care solution right now. And I kind of just hit on this a second ago. But I think that the active number for how many accounts are offering a long-term care solution is probably closer to half of that. Maybe 20% of the accounts are. I think a good portion of the accounts that are offering this in that percentage are those old grandfathered group plans, sometimes through like a Unum or other carriers such as that, not to pick on Unum, it's just one that we see regularly. So again, you might have clients that have had a solution in place. It's no longer active. they probably would like to have something moving forward. So those are always a good place to start. But either way, this can help an account really stand out and attract key employees or just the general population overall, from the top down. This is something where almost everybody has had to see a loved one go through it. And you never know who has a pre-existing condition or has somebody at home, that has a pre-existing condition that this could help. I'm going to jump to the bottom stat really quick, which is, obviously we're going to talk about executive carve-outs today. So executives also really get excited about this plan. It's hard to get executives excited about benefits, especially voluntary, benefits. And I think that's because it speaks to their language. It talks about protecting assets. Maybe executives have worked with a financial planner where they saw the difficulty of getting this type of plan. Maybe they didn't qualify from a underwriting perspective. They were denied, or they need more coverage now because of inflation, and they see the need for additional coverage. So you will see executives get really excited about this benefit. Also, many of the plans build cash, a cash value, so they see it as an asset. All of those reasons. The second stat from the bottom is one that we haven't talked about yet, and that is fewer than 1 in 30 Americans own a long-term care insurance policy, and only 7% of adults over the age of 50 actually have a plan. So contrast that against that top number that you see, where 70% of Americans over 65 will need long-term care. This is a grossly underinsured policy, and that's the reason why you're seeing more legislation or potential legislation take place. So let's touch on that really quick. Medicaid and Medicare are, government programs that help with long-term care. But Medicare is limited to 100 days, and then Medicaid only kicks in once assets have been depleted. So that means that your assets have gone to the state instead of you being able to pass them on to loved ones. Unfortunately, because so many people are not, addressing the long-term care need with all the stats that we just talked about, we're seeing a huge strain being placed on the Medicaid system. So the map that you're looking at right now is the percentage of each state's budget being dedicated to long-term care from the overall Medicaid budget. So just to point out some states that always jump out to me, you can see Maine on the top right is 30, my eyes are terrible, 35%. North Dakota at the top in the middle, 47%. And you're going to see all these other states that are, typically above 20%. Just like you hear politicians talk about Social Security being unsustainable unless some changes are being made, because the weight of it's going to collapse. This is very much the same thing with what's happening with long-term care in relation to Medicaid. They're having to force people's hands to address long-term care themselves. And that's the reason why legislation has started to develop, or potential legislation has started to develop across the country. So, and let me start this, going over this slide by saying this. The reason to offer long-term care should not be solely based upon avoiding a potential tax down the road. It is not the reason that there's a need for long-term care in this country. This is a symptom and a demonstration of what a need there is for long-term care in this country. So all the states that you see in blue here, they're all at some phase of developing legislation. Now, Washington State is basically the model because they were the first, they're the only ones to actually have passed legislation thus far. And a recap of what has happened there is that as of October 2021, the state said anybody that doesn't have their own long-term care policy, whether it be like an individual plan, like a traditional old standalone plan, or a hybrid plan like ours, they were going to be inserted into a payroll tax. Oh, and you can see on the top right that payroll tax was 0.58% of their income, whether you made 50,000 or 500,000, it didn't matter, 0.58% for the rest of your working career. And the whole purpose of that tax was to create a state-run long-term care benefit. Much like many states have the mandated state disability plans now, I think of it very similarly to that. Okay. Now, the benefit in Washington State, you can see on the top right, this bullet point, the first bullet point, the maximum benefit one could get from it was $36,500. That's not per year, that's the maximum lifetime. So that means $100 per day. Okay, now we just went over the stats. That is, less than a third of a year for a nursing home. It's, it's a drop in the bucket in the grand scheme of things. So, people that had their own policy were able to get out of this tax, get a hybrid plan or some other plan that gave them a higher benefit than $36,500, get a benefit that also has a death benefit tied to it, builds cash value like ours does in many situations. It was certainly advantageous, especially for people above a certain, income threshold. High income earners had even more reason to get out of that tax. Now, even if these other states start to pass a similar legislation, which they again are using Washington State as the model, it's not going to replace the need for additional coverage. Just like in states that have that mandated disability and FMLA legislation, there's still additional employer paid and voluntary disability in addition to that, but it gave everybody a baseline of protection. Think of this as being the same way. Now, one very interesting thing that we see, we have clients in all 50 states, Puerto Rico, and even Guam. And we thought the participation in Washington State was going to drop way down as new hires came on board, because they're already getting taxed. Many of them, they only had a one-time opt-out period for that tax. It was the opposite. Okay, we saw participation jump up, and even more importantly, in November during the election, the citizens of Washington State had the chance to overturn that legislation as being a mandatory tax. They upheld it. So a lot of the other states, we believe, from what we're hearing, we're kind of looking at that as being, something that they were waiting to watch and see how that went. Because if they were going to overturn that mandatory tax, why spend time developing our own? But it upheld. So again, each state's going to have its own guidelines, its own legislation. If it does come out, we think this is something that will continue to develop over the coming years. Do not, again, think of this as only offering this as a possible tax solution. It's for all the other reasons that we talked about. Okay, now here's a recap on how the plan works, and then I'm going to get into the strategies. Remember, all the carriers that we would work with work basically the same. In the top left, it's going to start as a death benefit. It's a death benefit at heart, even though this isn't replacing any life insurance that somebody might have as an employer through their employer or individually owned. Okay, there's no coordination of benefits. On the top right, they're all going to have a terminal illness benefit, meaning if someone has less than a year to live, they're going to advance 75% of that policy. The remaining 25% just goes to the beneficiary upon passing. And then on the bottom right, you're going to see the long-term care portion where all the carriers basically are triggered if 2 of the 6 ADLs that you see on the bottom of the screen are unable to be performed. Some carriers have a 4% pool per month that can be used. Again, the cash can be used for anything, the mortgage, the facility cost. Some of them have a 6%. Some of them can even go higher. But say this example is 4%. That means that money will stretch out for 25 months until 100% of the benefit has been exhausted. In most states, and most carriers, they have 2 riders on the bottom left, one being an extension of benefits, which means once 100% of the policy has been used after 25 months, they're then going to give you a second period of 25 months at another 4%. So essentially, the policy is now doubled in value in a long-term care situation, what it would be in a straight-up death benefit scenario. And remember, with these plans, if someone passed away before care was ever needed, like a sudden heart attack or a stroke, there's still a death benefit where traditional plans did not have that. The last rider on the bottom left is called full restoration. That means it doesn't matter when somebody passes away, before care was ever needed, during the 50-month care window, or even if they live for another decade after the care window was exhausted, the full benefit's going to restore and pay that beneficiary. So here's an example of a $100,000 benefit. Okay, on the top left, someone passes away suddenly, never goes into care. 100,000 goes to the beneficiary after tax, so none of the benefits are taxable. If they're terminally ill, 75,000 is advanced to the policy holder. The remaining 25,000 goes to, to the policy holder. The remaining 25,000 goes to the beneficiary upon passing. And then on the bottom right, after there's a 90-day elimination for care, okay, like any other traditional long-term care plan, at the end of those 90 days, 4,000 can be pulled out, essentially used by the beneficiary to navigate the care scenario however they see fit. $4,000 per month for 25 months. Okay, once that first bucket of money has been used, the first 100,000, they're now going to refill that bucket with another 100,000 that you would have another up to 25 months of access to. So now up to $200,000 worth of cash for care while the person's alive. But remember the full restoration at the bottom of the circle here. The benefit fully reloads once the person does ultimately pass. So you're going to get $100,000 regardless if it's before care is ever needed, during that 50-month care window, or even, again, a decade after the care scenario has been exhausted. So this $100,000 policy could actually up to triple in value up to $300,000. And we're using 100,000 to make the math easy. If someone had a $50,000 benefit, all those numbers would be cut in half. If someone had a $200,000 benefit, all those numbers would be doubled. So, couple more slides here, or one more slide here. A lot of times when we present this product, people assume it's only going to be people like in retirement age that take this. We see an equal participation among every age group, and I think that's because the rates lock in whenever you enroll. They usually build cash value, not always. So the younger demographics gravitate it, and then people closer to retirement age, obviously they're thinking about protecting assets. They might have pre-existing conditions, so on and so forth. All right, let's get into the employer paid strategies here. So there's three main strategies as we see it. There's an executive carve out only, okay, with the potential for them to buy up. There's executive carve out with voluntary for the remainder of the staff. Okay, so everybody has availability to the plan, but just the executives are carved out with an employer paid component. And you can, you can break that out, the carve out, however you see fit. And then lastly is employer paid for all staff, usually with a smaller base level than what an executive carve out would be, but with the ability to buy up from there. So here's an executive carve out only scenario and some of the features of, or the approach to how we see this fitting. And, one thing I'll say here is we showed you an example of, a group with 10 executives where they did $100,000 in life insurance as employer paid. So obviously you're going to help attract and retain some key employees this way. This is not a benefit that many companies are offering. You always want to give them the ability to buy up beyond the employer paid, because almost every single executive, or any employee in general, I think would want to do that. Many carriers, will give us a feature where if somebody takes any amount of coverage year one, it doesn't matter how much, even a minimal amount, they're going to then allow them to buy up additional guaranteed issue at any future open enrollment or qualifying life event, permitted that they're still working at that employer. So we call that the future safety net. You're going to see that, a few times here. So, so that means that, somebody gets any amount of coverage, they get this first 100,000, and then they develop cancer. Okay, that means that they would be able to add up to the remainder of the guaranteed issue at a future open enrollment. That wouldn't work in the, in the open individual market. Think of this as also working for even small family-owned businesses. You can see on the left the example here. With just 10 executives, we generated a monthly premium of $3,900, and at the bottom that generated $47,000 in annual premium and nearly $20,000 to our broker partner. This is a second scenario, where we did an executive carve out with the remainder of the staff being voluntary, and the reasons for doing this are, very similar to what we already just talked about. So they gave, in this example, a $100,000 benefit to the executives, just how we did on the last slide, but they allowed them to buy up in addition to that. And we used our average, annual premium, which is $1,400 per participant, and an 18% participation, which is what we tend to see. So a group of this size, we were able to generate, again, you can see the bottom of the screen here. On the employer paid side alone, it generated $470,000 in premium, or almost $190,000 in estimated revenue to our broker partner. And then from the remaining voluntary side of it, the premium was $252,000 with another $101,000 in revenue. So now a total of nearly $300,000 in revenue for our broker partner. So obviously you can see how much the employer paid component can move the needle here. Again, same features apply that we talked about before, where usually, with a group, especially of this size, anybody who took coverage, year one will have the ability to add up to that guaranteed issue at a future enrollment. And a group of this size, we're easily getting $200,000 in guaranteed issue. So even those executives getting $100,000 at the first enrollment, they would have another $100,000 to buy up, even if something bad happened. That's what this slide speaks to, the ability to buy up at future enrollments. Again, someone can take just like $5,000, $10,000 and be able to buy up to that maximum as long as they're still working for that employer. Now, here's a base level where it was a base level approach where the employer, didn't want to carve it out for executives, but they decided they were going to pay a small amount for everybody. Okay. One thing I didn't talk about here, I'm sorry, I'll come right back to this. With the executive carve-out approach, okay, whether it be for a small group or, a group here with 100 executives, we're usually able to negotiate a higher amount of coverage than what the maximum benefit would typically be. So a lot of the carriers are limited to $250,000, $300,000 total. Some of them will allow for a reinsurer to come in and bump that up to 500,000. Still guaranteed issue if employer paid. So keep that in mind. Okay, even like a small 5-person, family-run business can generate a lot of income or a lot of revenue that way, and you're providing them a benefit they probably wouldn't be able to get otherwise. Now, again, here's the employer paid base level. Example. We did that same 1,000 person company, all base level. Each employee only got $10,000 of coverage initially, but they have that future safety net. Okay, they know that they can buy it more, and you always see employees take additional coverage. Again, using our average participation and annual premium that generated from the employer paid, even though it was just $10,000, over $302,000 in premium, 121 in revenue, 121,000, and then the additional voluntary beyond that generated a total of $232,000 in revenue for our broker partner. When we show quotes, we usually show above 10,000, 10, 50, 100,000, but we can break that out however you want. And here's just some examples of organizations and the type of premium that we've been able to generate for our broker partners. So you can see right off the bat, a few $100,000. And most of these are from voluntary only. But just to give you a kind of an idea on what our results, even if it's a voluntary only, enrollment, we're averaging about $500 per participant to our broker partner. And again, about an 18% participation. So I want to leave some time for, for some questions. Please feel free to throw them in the chat, or it's obviously people can unmute themselves at this point. One more plug, shameless plug. We have another weekly or monthly webinar coming up on May 15th, and we're going to go over some legislative updates and go over some case studies at that time. Okay, so I appreciate you all joining, and I'm happy to answer any questions that you might have.
Matt, we do have one question in the Q&A. Michelle said, especially with a small family firm, do you ever see someone want to offer just executive/owners employer paid coverage and not buy up to simplify admin? Is this possible if you have the 10 minimum lives?
Yes, we do see that. And carriers on smaller side, we have solutions down at just 5 applications, and that can include spouses. So really there's, as long as there's 5 applications total, we can usually find a solution in most states. So we do see that.
Thanks, Matt. That was the only question as of right now that we have in the chat. Everyone does have the ability to unmute themselves if they wish to ask a question.
So my contact information is on the screen. I appreciate everybody for jumping on today. Those of you that I know, those of you that I don't know, please shoot me a line. We'd love to talk about some opportunities. Hopefully we gave you some ideas that you didn't know about before. And even on the employer paid side, we showed the smallest example being 10,000. We've gotten exceptions to go down at just 2,500. So like with the underwriting that we have, it's unique. There's not many other firms that have that in the country. We can find creative ways to help your accounts and help them provide a benefit with no medical questions and provide solutions that their employees wouldn't be able to find otherwise.
Hey, Matt, this
Yep.
is Steve Scammell. Is this PowerPoint available to us?
Chelsea, I don't even know the answer to that. I know we posted on our social media.
Steve, yes, we can send you over a copy of the PowerPoint along with the recording. Just give us a few hours just because we have to generate the recording, and then I'll get that over to you.
Perfect. I appreciate it.
Of course.
I mean, there's some really good stuff in there.
Thanks,
Great.
Steve.
I'm glad that you find it informative. That's amazing. Matt, we have one more question from Michelle in the Q&A. She's asking what carriers?
So we work We work with any of the carriers that would make sense, but we don't, like, it's not a shotgun approach. The primary carriers that we work with are Allstate, Transamerica, Trustmark, some Chubb, some MetLife. There are some other carriers sprinkled in there, but those are our 5 primary carriers.
Great. Thanks for that, Matt. It looks like that was the last thing that we had. So yeah.
All right. Thanks again for everybody, and we look forward to talking to you soon.